Okay, so in the world of crypto, you've got projects that launch, and then you've got projects that, well, they just detonate. Today, we're diving deep into one of the biggest detonations of 2025, a decentralized exchange called Aster. This thing showed up out of nowhere with numbers so completely wild, it felt like they were rewriting the rules of DeFi right in front of our eyes. Let's get into it. First up, let's just talk about the sheer speed of this thing. On September 17, 2025, Aster drops its token. And get this, within just 6 hours. I'm not talking 6 days or 6 weeks, but 6 hours. The price just skyrockets by 1,500%. I mean, early investors were seeing the kind of returns you only dream about, and it happened almost instantly. This wasn't a launch, it was a full-on vertical takeoff. And it wasn't just the price. With that surge came an absolutely mind-blowing amount of trading volume. At its very peak, Aster was reporting daily trading volumes of $27.7 billion. To give you some perspective, that's more than the entire GDP of a whole bunch of small countries traded in a single day on a brand new platform. The scale was it was massive.
So, what was pulling everyone in? Well, features like this definitely didn't hurt. Aster offered a maximum leverage of 1001x. I mean, that number's almost a joke, right? It's like a siren song for the riskiest, most degenerate traders out there, promising these astronomical gains from the tiniest little price wiggles. It was a pretty clear signal that Aster was built for one thing: pure, uncut speculation.
So yeah, these numbers, they just scream one question, don't they? A 1,500% pump at launch, billions in daily volume, totally insane leverage. How on earth did one platform pull all of this off, seemingly from thin air? Well, to answer that, we've got to look under the hood at the one big idea that was powering the whole Aster machine.
All right, so to really get what made Aster tick, we have to start with its core innovation. See, this wasn't just another exchange throwing random features at a wall and hoping something stuck. Nope, this was built from the ground up to solve a really fundamental problem that frustrated a ton of DeFi traders.
And this right here was that big idea. It's so simple, but so powerful. On most trading platforms, the money you put up as collateral, your margin, it just sits there. It's dead capital, doing absolutely nothing for you. Aster's whole game was built around this thought. What if that money could be earning you passive income while you were using it to trade?
They called it yield-bearing collateral. But here's an easier way to think about it. Imagine the security deposit you put down on an apartment. Normally, your landlord just holds on to it, right? But what if you earned interest on that deposit for the entire time you lived there? That's exactly what Aster promised for your trading funds. Your capital could finally do 2 jobs at once.
So how did they actually pull this off? Well, the trade and earn engine was, for the user, surprisingly simple. You'd take a popular crypto asset, something like BNB, and you'd stake it. In return, the platform would give you a liquid staking token, in this case, as BNB. Then, you could use that token as your collateral for trades. And boom, what's the result? You're earning staking rewards on your original BNB, and you're trading with it at the exact same time. It was the ultimate promise of capital efficiency, 2 income streams from just one pile of money.
But wait, there's more. Aster was not a one-trick pony. They layered on a bunch of other features that were really hard to ignore. They had hidden orders to protect big traders from getting their strategies copied. They had support for major chains, like Ethereum and Solana. They even had perpetuals for stocks like Apple and Tesla. But the real kicker, the one detail that gave Aster instant street cred in a super skeptical market, was its backing from YZ Labs, the powerhouse investment fund started by none other than Binance's founder, CZ.
For a hot minute there, Aster looked absolutely unstoppable. It had the cool tech, it had the big name backing, and it had those unbelievable numbers. But then, the whole story took a very, very sharp and very public turn for the worse. The very same volume that made Aster famous was about to become its greatest weakness.
Okay, so picture this. October 5th, DeFi Llama, one of the most trusted data aggregators in the entire crypto space, they make a sudden move. They just completely delisted Aster's trading volume from their platform. They were basically screaming to the whole world, "We don't believe your numbers."
And they didn't mince words either. DeFi Llama's founder, 0xNME, came right out and said it. He publicly called them out for suspected wash trading and even noted that Aster was refusing to provide the detailed data they needed to prove the volume was real. The accusation was direct, public, and absolutely devastating.
So what the heck is wash trading, anyway? Well, in simple terms, it's faking it.
It's when an entity, or maybe a bunch of coordinated bots, just trades back and forth with itself over and over. No real economic value is being created, but on the surface, it creates this illusion of a super busy, high-volume market. In DeFi, people usually do this to farm airdrop rewards or just to climb the rankings on data sites to look way more important than they actually are.
So what was the smoking gun here? Well, the evidence that DeFi Llama pointed to was this stunningly obvious data anomaly. Analysts started noticing that Aster's trading volume for certain pairs, like XRP, was mirroring the volume on Binance, the biggest centralized exchange in the world, almost perfectly, like a one-to-one match. And that should never happen with organic trading on a decentralized platform. It was like finding a perfect carbon copy where you should have found a unique, messy fingerprint.
In this chart right here, it just lays the whole disconnect bare. So on October 3rd, Aster is claiming over $41 billion in volume, just dwarfing its competitor, Hyperliquid. But then, look at the open interest. That's the actual, real money that's locked in open trades. Hyperliquid had nearly 3 times more capital at stake with just a fraction of the volume. This huge mismatch was a massive red flag. It suggested Aster's volume was all fluff, while Hyperliquid's was backed by real traders with real skin in the game.
You know, once that first crack appears in the dam, everything starts to pour out, and that's exactly what happened here. The wash trading accusation opened the floodgates. As analysts started digging deeper, they found that the suspicious volume, well, that was just the tip of the iceberg. There was a whole constellation of other risks hiding right beneath the surface.
The problem, it turns out, was literally built into its DNA, into its tokenomics. Look at this. A massive 53.5% of the entire token supply was set aside for airdrops. Now, on the surface, that sounds generous, right? Free tokens. But what it actually created was this really twisted incentive. It directly encouraged people to wash trade, because users could just spin up bots to generate fake volume simply to farm more and more airdrop points. The system was literally paying people to fake their activity.
But hold on, because it gets so much worse. On-chain analysis revealed a level of centralization that is just shocking. A staggering 96% of the entire Aster token supply was reportedly controlled by just 6 wallets. I mean, that completely torpedoes the whole idea of a decentralized community-run project. With that much control, this tiny little group could manipulate the price or change the protocol's rules whenever they wanted.
And the red flags just kept piling up. The CEO, this person known only as Leonard, was completely anonymous. Nobody knew who he was. That insane 1001x leverage, that created a huge systemic risk where one tiny market dip could set off a catastrophic chain reaction of liquidations. And critically, their own stablecoin, USDF, got its yield from strategies on Binance, which means a key part of Aster's ecosystem was completely dependent on a centralized exchange, a huge single point of failure. So with its reputation completely in tatters, you'd think game over, right? End of story. But this is crypto, and things are never quite that simple. Faced with this massive crisis of trust, the Aster team didn't just pack up and disappear. Instead, they doubled down on their long-term vision, hoping they could innovate their way out of the whole scandal.
So what was their big plan? Well, the roadmap essentially became their Hail Mary pass. They planned to launch something called Rocket Launch to bring new assets onto the platform. More ambitiously, they announced Aster Chain, their very own custom Layer 1 blockchain built specifically for private high-speed trading. And looking further out, they plan to integrate zero-knowledge proofs, this really cutting-edge privacy tech that would let them verify trades without revealing any of the data, making trading truly anonymous.
The message here was crystal clear. They wanted to pivot. They were saying, we're not just another trading app anymore. Our vision is to become the core foundational infrastructure for trading across all of DeFi. By building their own chain, they could offer up their privacy and performance features to other projects, basically embedding themselves into the very fabric of the ecosystem.
That, my friends, leaves us with the central unanswered question. Aster's story is a classic crypto paradox. On one hand, you've got some genuinely innovative tech and a really bold vision for what the future could be. But on the other hand, you have a foundation that's been rocked by these serious allegations of manipulation and huge centralization risks. So, can a project like this actually come back from that? Can brilliant code and ambitious roadmaps ever be enough to rebuild the trust that was so completely shattered? That's the billion-dollar question that Aster still has to answer.